Hey, it's Tom here and welcome back to the channel. So as some of you may know, one of the positions in my own personal portfolio is Seritage Growth Properties. I'm a shareholder in that business and have been since late to mid 2020. It really first came on my radar when Monish Prabrai invested in it following the massive decline in share price that Seritage experienced in March last year. And I've also done a couple of live streams here on the channel with stock compounder Brad Kellner, basically analysing the Seritage Growth Properties business and going through SRG from an investment perspective. Now, one of the things that I think a lot of people do when they put a position in their portfolio, when they buy shares in a company, is it's kind of human nature that we have this tendency to seek out information that sort of agrees with our own investment thesis. You know, we see it in all aspects of life, but investing in particular is one where I see a lot of people that are invested in a particular company pretty much only say the positive things about a company. And I think it's important to make sure that you're able to invert your investment thesis, like Charlie Munger back here would, and you're able to understand some of the negative aspects of investing in that particular company. And you're also able to sort of rebut a lot of those points against the people that are maybe on the short side of that particular stock. So this video is actually kind of inspired by Brad, who I did those Seritage live streams with. Brad last year put up a video basically about a position in his portfolio, which at the time was Micron. And the topic of the video was basically why Micron sucks. And he went through all of the bearish points for Micron, went through sort of a short thesis, and wanted to understand the perspective of the people who've sort of landed on the other side of the equation when it comes to investing in a business like Micron. So in this video, I basically want to do the same thing for Seritage Growth Properties. I've sort of compiled all of the common reasons why people really don't like Seritage Growth Properties and why they wouldn't invest in the company. So I basically want to go through each of those points one by one, understand the perspective of people that have those thoughts on Seritage Growth Properties. And I also want to then give sort of a rebuttal to some of those points and my thoughts on the particular points that commonly come up when people really turn away from Seritage or even shorting Seritage Growth Properties. Because again, as Charlie Munger tells us, we should understand the short side of any particular investment. We should be able to invert our investment thesis, and we should really understand those short thesis points better than the short seller and be able to, you know, argue against them and so on. So that is the topic of today's video. I do hope you enjoy it. If you do, please hit like and hit subscribe. And on the topic of Seritage Growth Properties, if you think there's any key kind of points that I've missed about why people sort of pass on Seritage or even shorting Seritage Growth Properties, if you think there's any major points I've missed, definitely drop them down in the comments below, because again, you know, I've got my money in this thing and I want to understand why people might not think that that's the best idea, so that I can be as rational as possible and make a good decision with my investing. So with all that said, let's get straight into some of these bearish points for SRG, and I hope you enjoy. Okay, so the first reason that commonly comes up about why SRG sucks is that they have negative cash flows. If you look at their income statement for the past few years, you'll see revenue is declining, earnings have been consistently negative, and basically the business is just burning cash. And that is entirely true. That is one of the first things that I noticed when I took a look at Seritage Growth Properties. Is I think I even said it out loud. I was like, well, this is really bad. Something along those lines or to that effect. Yeah, they've been losing a lot of money and revenue's been declining. Earnings don't look great. In fact, they're very negative. So that is one of the main bearish points and one of the first kind of obvious ones that comes up. And I basically want to talk through my sort of counter, or at least that's sort of an explanation why I see that is happening. And of course, if that just goes on indefinitely, that is not a good thing for shareholders. That is how you end up in bankruptcy court. But I want to kind of talk through why that's happening and kind of my perspective on the whole thing. So the story with Seritage Growth Properties is basically they have all of this real estate that was initially largely Sears stores. So Seritage got spun off into its own sort of entity as the real estate portion of Sears, before Sears then went bankrupt. And essentially, ever since that happened, Seritage have been going through this process of doing a couple of things. So firstly, they are kind of getting away from, obviously, Sears as a major tenant of theirs. That now accounts for, I believe it's well under 1% of their revenue, so I've sort of ticked that box off pretty well. And the other thing they're doing is they're redeveloping a lot of their properties in order to firstly sort of re-rate the rental prices that they're able to get. So they're seeing multipliers of 4 or even 5x in terms of the rental income per square foot that they're getting on these properties with new redevelopments and new tenants kind of coming in. And the second thing that they're doing is also sort of consolidating the portfolio. So they're selling off any of their real estate that they don't see as attractive from a redevelopment sort of perspective, and they don't think they can create a lot of value with, and they're using that cash to then fund redevelopment opportunities. So, if you think of it like, you maybe owned 2 or 3 rental properties and you had some tenant that have been in there for 10 or 20 years or something, paying really low rents, and then you had the opportunity to just bowl those houses and put, duplexes on them or something, increase the square footage and also get a much higher rent per square foot, that could potentially be really attractive once that project is complete. But in the meantime, you're going to have a dramatic decrease in revenue because you have a lot of vacancies as you bowl over those houses and so on. And that's kind of just something that's expected to see in the short term at least. So yes, that's the first point, negative cash flows. It's a very, very good point, but when you think about it in sort of the context of what SRG are trying to get to at an end point, I think it's kind of expected to see that in the financial statements. Okay, the second reason why Seritage Growth Properties sucks is that they have very little cash sort of liquidity, and they have a large amount of debt. And again, this is a very good point. So if you look at some of the figures from the latest 10Q for Seritage Growth Properties, you'll see that they had about 138 million in cash and cash equivalents. They only had a net operating income of about $9.4 million from the last quarter, and the interest payments for the last quarter are about $26 million. So all of their debt is to Berkshire Hathaway. They have about $1.6 billion worth of debt owing to Berkshire, which they pay about a 7% interest rate on. So not the most attractive debt in the world, but as we will get to shortly, Berkshire are actually quite a nice debt holder to have in terms of not dragging you through bankruptcy courts and things as times get tough. So yeah, it's a very good point. You have NOIs of about $9 million and you have quarterly interest payments of $26 million, and those things do not reconcile very well. So again, one of the things you have to keep in mind with Seritage is they're going through this transition phase, and they actually have a lot more liquidity available than what just looking at their cash and cash equivalents might suggest to you. So like I said, they have sort of a core kind of handful or so of properties that they're looking to redevelop and dramatically increase the square footage on. And that essentially means that they have every other property available to sell, which is actually something that is fairly liquid at the moment. The real estate market is obviously very hot, not only in the US, but really many places around the country. New Zealand actually is no exception to that. So they're able to quickly monetize a lot of these properties that they don't see as attractive for redevelopment in order to fund their debt obligations and in order to also fund any redevelopments. So yes, they have a lot of debt. Yes, they have relatively low net operating income, at least right now, but they have more than enough assets and equity in order to fund these payments. So if you look at, for example, some of the work that Brad did in our first live stream, he basically came to the conclusion that he thought Seritage had about $60, maybe $60 to $65 per share in assets, and that doesn't include any value that's been created from future development projects SRG kind of have on the go. They have about $28 per share in debt, so you get about a liquidation value of about $30 to $35, somewhere in that range. So current share price is maybe like $18 or $19, I think. So you have a fair bit of kind of margin of safety in terms of the discount to net asset value, and you also have a lot of liquidity that can be made available if required. Okay, so the third reason why Seritage Growth Properties sucks is basically to do with management, and more specifically management turnover. So in the end of 2020, I think it was late 2020, we had both the CFO and then the CEO leave Seritage Growth Properties to go elsewhere. And that, of course, is very much a red flag initially, and I want to kind of go through some of the points on why I think that happened and why I think it's actually fairly understandable from the CEO's perspective on why you would move on. And then also I want to talk about the new CEO, Andrea Olshan, and some of sort of her track record and sort of some of the potential red flags that appear when you look into what she could potentially do with the company as well. So in terms of Ben Schall, so Ben Schall was a CEO that left Seritage Growth Properties. Basically, I think you, in many cases, and this is no exception, you have to look at incentives. So Benjamin Schall basically got headhunted to go to a much larger real estate investment trust than Seritage Growth Properties. So he went from SRG, which has a market cap of something like $1 billion, give or take a little bit, right now, and he got sort of picked to go to Avalon Bay Communities. And Avalon Bay Communities has a market cap which is about 30 or 40 times greater than Seritage. So it's a much larger gig, basically, a much larger company to go to. And of course, whenever you get to move to a new company, particularly one that's much larger, you get a reset in your salary and your options and bonuses and so on. So I did actually a bit of digging on Benjamin Schall's compensation package at Seritage versus at Avalon Bay Communities last night before when I was sort of putting some notes together for this video, and this is basically the situation for Ben Schall. So when he was at Seritage, he had a base salary of about $850,000. If you include everything, so stock options and bonuses and all that kind of stuff, he was basically up at about $4 million in total compensation, about $4.1 million. Now, if you compare that to what he's now getting at Avalon Bay Communities, he's starting out fresh at $7.5 million. So he's got about $3.4 million to go to a business that is much larger, much more prestigious, and he's getting double the salary. So frankly, I don't blame the guy for moving on, and that's kind of the situation with Ben Schall leaving. Now, in terms of the new CEO, that is Andrea Olshan. So Andrea Olshan has actually come from a family real estate business, and one of the initial criticisms you often hear with Andrea Olshan is she has come from this real estate business and potentially has kind of just got pulled in from the fact that her dad and family has a great reputation rather than her own track record, which I think is kind of a tough one to judge. Why wouldn't you want to continue working in the family business and kind of continue your family's legacy in the real estate industry? So, that's a bit of an interesting one to kind of analyze. Did Andrea Olshan really get this job on merit, or did she get it because of her, family's track record? Kind of hard to say, but will be interesting to see how this one plays out. The other thing that is a bit of a red flag that did actually come up, and a subscriber kindly sent this information to me initially, actually, is Andrea Olshan was actually involved in, or at least her family, she was one of the people on the board in this case, were actually involved in a hostile takeover of a group called Morgan's Hotel Group, which happened in the early 2010s, I think. I don't have the date on me right now, but maybe I'll put it up on the screen here, a rough date. And basically they went in and bought up about 15% of the stock and eventually got seats on the board and took over the business. And that is a bit of a red flag. Now, I must say that the obvious rebuttal to that is the family has nowhere near that shareholding in the business. Eddie Lampert controls a huge amount of it. There are some other large shareholders as well, so I really don't see anything like that happening. But certainly it's a red flag, and it's one of the actual why SRG sucks points that I'm most closely keeping an eye on. So that's a fair one, to tell you the truth. I don't have a very strong rebuttal to that. I don't like to see management turnover, but I can understand why it happens, and it's certainly one to keep an eye on moving forward. But at the same time, of course, it's worth noting that a lot of the value of Seritage Growth Properties is really not to do with the actions of the CEO necessarily. It doesn't change the value of the portfolio or the, resale value of the real estate or anything like that. So that part of the thesis is unchanged, but there is going to be some execution certainly required in order to go through many of these redevelopment properties, and we'll just have to keep an eye on that situation. Okay, so the fourth reason why SRG sucks is that this thing is going to take a long time to play out. We've been seeing the revenue and the earnings decline basically ever since SRG became its own spin-off, separate entity to Sears. And the situation, at least on the surface of things, when you look at the financial statements, hasn't really improved. And it's going to take a long time for this thing to play out. So if you look at one of the really big opportunities in terms of redevelopment and increasing the rental income, they've got this Dallas property, which is one that Monish Pabrai actually talked about in a podcast not too long ago as well. And if you look up online some of the timelines around this Dallas property development, it's actually not expected to come online until about early 2023. So the development's going to be split into a couple of phases, and the first phase is expected to be sort of ready for to be rented out at least from early 2023. So we're looking at potentially up to a couple of years here, maybe even longer, to get the full development of that particular property up and running. And it's just sort of a long time to wait to see, whether things are going to play out in our favor or not as shareholders. And it's also going to mean that we're going to have a longer, period of time where cash is potentially being burnt in relation to that project. And anytime you're burning cash for a long period of time, it kind of deteriorates from the net asset value and so on, which I'll actually get to in another point shortly. But in terms of the Dallas property, my rebuttal is basically this, and that's the fact that, on the back end of this development, I think the wait is going to be more than justified. So if you put it back into the example that I talked about earlier, where maybe you own a couple of rental properties, they're single family houses, and you're going to bowl them and put them in duplexes and massively increase the rent and the square footage and so on. Of course that's going to be painful in terms of cash flow in the short term, but on the back end that's probably going to work out pretty attractive, or else you wouldn't even bother doing these projects. So that's the first point, is that I think the wait is going to be worth the while, I suppose. And the second point, and this is actually a point from Guy Spear, which he did in a Manual of Ideas talk on Seritage, where he basically pitched the idea, is he said what starts off looking like it's forever comes around within no period of time. And that was, like I say, Guy Spear talking about SRG specifically. And it's been said by several famous investors. I think Seth Klarman was one of the main people that I've seen say this. And that is really having a long-term time horizon as one of sort of the few remaining competitive advantages or edges that any individual investor can have in the stock market. There's so much information freely available that it really comes down to your temperament and your willingness to wait in order to get gratification on the back end that can really provide you some competitive advantage in the market. Okay, so point number 5 on why SRG sucks is net asset value may be high, but it's going down all the time with cash burn. So, as cash has been utilized in certain ways within the business, that cash has been burnt, debt potentially may need to grow into the future, the portfolio is shrinking in terms of the number of properties, and presumably the net asset value is shrinking as well. Well, this is the way that I look at it. Basically, cash within Seritage has been used for two things. So, the way I would sort of split those two categories up and think about them is there's costs that are just related to generally running the business. So you've got our corporate overhead, obviously interest payments to Berkshire Hathaway being the debt holder in this case, basically everything that's required to just keep the business running. So that's the first category that I'd give you. And the second category that I would give you is the redevelopment pipeline and money being spent on improving the existing properties. So in terms of the corporate overhead and interest payments, of course, that is cash that just goes out the door, and we don't necessarily see any increase in the value of the assets that Seritage Growth Properties owns when that sort of happens. But on the other side of things, when money gets put into development projects, I really see that as a dollar being spent to create far, far more than a dollar in asset value for shareholders. And that, I think, is the way that we need to think about this. So, a lot of people in this case are arguing that potentially net asset value is going down. I would argue that as these redevelopments come online, the exact opposite effect is actually happening. So, several dollars are being spent in order to create new real estate that can rent at very high prices, and it's also increasing the square footage, which again, you kind of get this double whammy of increasing rental income. And commercial real estate, of course, is priced based off the amount of income it can produce. So I really do think that the net asset value over a longer period of time will in fact grow rather than shrink. Yes, they're burning cash in the short term, but that cash has been funneled towards, to a large extent at least, many of these redevelopment projects, which will result in sort of back-end cash flows for shareholders. So that is the next point there. Point number 6, and our second to last point on why Seritage growth properties sucks, is just frankly uncertainty. The uncertainty of future cash flows, the uncertainty of how long some of these redevelopments will take, the uncertainty of how large or small the cash flows will be on the back end after this portfolio is fully redeveloped and kind of consolidated into a smaller number of properties. There's just a lot of uncertainty and a lot of unknowns around what is going to happen out into the future for Seritage. And I would tell you, yes, that is correct. There is a lot of uncertainty. But as an investor, and again, Monish Pabrai will tell a lot of people this, he wrote about it in The Dando Investor in his book, which is a really good book, by the way, if you haven't read it. He wrote that really markets confuse risk and uncertainty all the time. And anytime that there is high levels of uncertainty, which there certainly is with Seritage, but low levels of risk, which I will get to in a sec, and of course, none of this is investment advice, this is just my perspective, but anytime there is high uncertainty and low risk, that is a situation where investors can potentially make a lot of money. That's the way that Monish Pabrai has thought about it for a very, very long time. So yes, I would in fact agree with the bear case here that uncertainty is very, very high, but we really have to balance that against risk. Risk in terms of permanent loss of capital for shareholders. So this is the way that I'm currently looking at the risk in Seritage. Firstly, we have a big discount to at least our estimates of net asset value. So net asset value without including some of these larger redevelopments is probably in the $30 to $35 range, somewhere in that ballpark. There's a bit of leverage built in, so potentially that range could be a bit wider, but it's somewhere around there most likely. And the current market price is about $18 or $20, I think. I bought most of my stake around $12. Monish Pabrai bought most of his stake around $7 or $8, I think. So, there was a lot of margin of safety at those prices relative to the net asset value of Seritage. So that is the first thing, and that is something that really reduces the risk of permanent loss of capital if you can buy at big discounts to net asset value, assuming, like we talked about in the last point, that net asset value is not just disappearing by the day. The second thing, like I mentioned already, is that markets often confuse risk and uncertainty. And the third thing is that as time goes on, the level of uncertainty can really only go down. So I think we're probably in as uncertain of a time as there frankly will ever be, perhaps with the exception of last March or something, with Seritage. And as these redevelopment projects continue to happen, and as a portfolio in terms of the number of properties at least, but not necessarily the rental income, continues to shrink, we will only get a clearer and clearer and clearer picture of how Seritage is going to play out. And as that happens, I think there is a good chance that a lot more people get a really good handle on what the potential future cash flows could look like for SRG. Okay, so the seventh, and in my mind potentially actually the largest reason why SRG sucks is, Eddie Lampert could potentially take this thing private. So for those that don't know, Eddie Lampert is sort of a controlling shareholder at Seritage. There's a few different share classes with SRG. So you have the regular Class A shares, you have the preferred stock, and then you also have these operating partnership units, which is largely what Eddie Lampert owns. So, could Eddie Lampert potentially take SRG private and really capture the value created by many of these redevelopments and just the value of the real estate in general? Could he capture that value himself for his investors in a private entity rather than have the pressure and, transparency that you have to provide as a public company? Is that something that Eddie Lampert could do? And I think potentially he could, and that's arguably the biggest risk for shareholders, is that they could really be taken out of this thing at a price that is much lower than where they would really like to sell. And Eddie Lampert has been in SRG for a while. He's been in since the Sears days, and he has a pretty large percentage of his fund and probably of his own personal net worth tied up in this thing. And again, in the words of Guy Spear, I think Eddie Lampert is probably very acutely aware of what the real estate value of Seritage growth properties is. And for that reason, I think, yes, there potentially is the chance of like a buy under kind of transaction going on. So particularly if the share price really drops to a point where it's just a ridiculously large discount to net asset value, I think there potentially is a chance that Eddie Lampert, buys out remaining shareholders and takes the thing private for his own fund. I will provide a couple of sort of counterpoints on why I think Eddie Lampert potentially wouldn't do that. I think, yes, the risk becomes larger if the share price does drop at some point, but it's worth noting that this kind of transaction didn't happen when the share price got as low as $5 a share. Now, like I say, it's more like $18 or $20 as of filming this video. So it's worth noting that he didn't do it at prices, 70% lower than today or something. So that's something to keep in mind. But of course, when the share price was that low, it was far more uncertain times. Berkshire Hathaway hadn't yet been as lenient on the interest payments and allowed Seritage to sort of kick that can down the road and defer the interest payments. There was a lot less clarity on whether SRG would even have the liquidity to survive, let alone thrive during that period. So something worth noting, but I think it is a genuine risk that shareholders should keep in mind with Seritage. Okay, so those are all of the reasons why potentially Seritage Growth Properties sucks, and I hope you enjoyed the video. I think it's an interesting exercise to go through and pick out things in your portfolio and try to understand all of the worst possible reasons why you would own them. And it's nice to get that sort of feedback and actually make you think critically and try to be rational about this kind of stuff. I think a lot of people can seek out information very easily that confirms their own thesis, but you have to understand both sides of the equation really, really well, and that will allow you to sleep better at night, and you're just being a better, more rational investor if you can do that. So hope you enjoyed the video. Like I say, if you think I've missed any major points with SRG, definitely drop them down in the comments below. I'm always open to hearing different opinions on any company in my portfolio or on my watch list. So if you want to drop anything down below, that would be much appreciated. But that's it from me for this one, and I will see you in the next video. Cheers.